Today, I want to introduce you to Sam. Sam sold their business for $2 million, but ended up with less than half after taxes. Today, we're sharing the long-term planning strategies that could have saved Sam hundreds of thousands, and how you can protect yourself and your business legacy, whether you're planning to sell, pass it on to some beneficiaries, some heirs, children, those kind of people, or if you want to just become an absentee landlord of your business, right? Where it runs and you just collect a paycheck. We're going to cover all those today. Buckle up. Here we go.
In a world where chaos seems to reign supreme, where uncertainty lurks around every corner, and financial markets are now more unpredictable than ever, there's one place you can turn to find clarity and control. Welcome to the Wealth Wisdom Financial Podcast.
Hey, I'm Brandon.
And I'm Amanda.
Join us as we dive deep in the world of personal and business finance
to assist you in navigating through the chaos and building the financial future you deserve.
We believe when conventional financial thinking doesn't get you where you want to go,
you need wealth wisdom.
So if you're ready to take control of your financial destiny,
tune in to the Wealth Wisdom Financial Podcast.
Because in a chaotic world, your money shouldn't be.
Subscribe now and never miss an episode.
Okay, welcome back. Today, we're talking about something most business owners don't even want to think about, and they put it off until it's too late: long-term tax planning. And I don't just mean next year's taxes. I mean the big picture: retirement, selling your business, passing on your legacy, whatever it might be. And Brandon's not joining us today. It's just me, because I'm going to go really fast. I got a lot to cover. I know your time is valuable, and you're going to maybe slow this down, listen to it multiple times, bring it to your tax pros, bring it to your financial planner like me, and let's make sure we got you and we're making good decisions, not just short term, but also long term. Here we go. Here's the big idea. Here's what catches most business owners off guard. The tax strategies that work great for your business today might actually set you up for a bigger tax headache down the road. Let's look at Sam's story to illustrate this, and then we'll break it down. Sam built this successful business and manufacturing over 30 years. They did everything right for annual, quote unquote, right, for annual taxes, maximizing deductions, reinvesting profits, keeping great records. But when they sold the business for $2 million to fund their retirement, they were shocked. Between capital gains taxes, state taxes, extra Medicare charges for the higher of income, they walked away with less than $1 million. The worst part, most of this could have been avoided with better long-term planning. So let's talk about 3 key areas of long-term planning that most business owners miss. And we're going to talk first about planning for a business sale and the taxes there. The second we're going to talk about is planning for passing on your business to your children or other beneficiaries. And then the third one is planning for when you get to, quote unquote, retire from your business, but still own it. One quick reminder first: I'm not a tax professional. This episode is meant to empower you with knowledge to bring to your tax professionals, not giving anybody individual advice. We're just sharing some great information that we think will help you have better conversations and make better decisions as you collaborate and work with your tax pro, which you've got a collaborative tax pro, right? Okay, good. So first, let's dive into planning for a business sale and the taxes there. First, you want to understand how the sale will be taxed. Are you setting up for an asset sale or a stock sale? Each asset category in an asset sale has different tax treatments. And an asset sale is when a buyer purchases individual business assets. So if they're purchasing your equipment and inventory, that might be taxed as ordinary income. If they're buying a building, then you might have a 25% rate on depreciation recapture. If they're buying goodwill and other intangibles like copyrights, then you might get capital gains rates in terms of the taxations there. And usually buyers prefer to do an asset sale for better tax treatments for themselves, long term, but it can result in higher taxes for sellers due to that, especially that depreciation recapture. If you're doing a stock sell, this is where the buyer purchases the actual business entity. This is usually better for sellers because you get one tax rate on the entire sale. but it's harder to get buyers to agree to, partially because there's some liability they take on from past business practices that they have no control over what happened in the past. This is also more important for corporations than LLCs. So part of this with the asset sale versus the entity sale is that buyers and sellers are just going to have competing interests. And your taxation might be one of your interests. And of course, the buyer's eventual taxation, if they resell it, is going to be one of their big interests that they're looking out for. So there's some structures that spread taxes over multiple tax years. So you could do an installment sale that lets you pay your taxes as you receive payments. You can do earnouts that spread your income over several years. You might even set up an employee stock ownership plan, an ESOP, that can defer to the taxes until you want or need to use the funds. So even as you get into the buyer's part, right, you can have some tax advantages that you have more control over, and maybe they're open to an installment sale, an earnout, or an ESOP. So before you even get though to the negotiating table, there's some steps you can take before the sale. First, clean up your books and your records. Make sure you've got, personal and business expenses clearly separate. Document any asset purchases and improvements. Keep good corporate minutes and records. Just clean up your books and records. We talked about that a lot this month. Go back and listen to previous episodes if you're not sure how to do that. We got some shortcuts for you. Another thing is consider whether converting to an S Corp, if you're not one already, might be in your interest there. This has to be done at least 5 years before a sale to avoid built-in gains tax, but it can save you significant self-employment taxes even as you go throughout your business before you sell it. And it also allows for better sell structuring options if you're an S Corp or filing as an S Corp. Document improvements that you're making that increase your cost basis. Keep receipts for any kind of capital improvements. Track your sweat equity contributions. Document major business process improvements. Make sure if you're putting extra value into any kind of capital asset that you've got those things documented. Okay, so there's just things you can be doing in the meantime. And then there's some things you want to avoid, some common mistakes that will increase your taxes at a sale. One is waiting until the buyer appears to start planning. This limits your structuring options, gives you less time to clean up issues, might force you to accept less favorable terms. So start preparing now, even if you're not planning on selling for a long time. Also, make sure you don't make the mistake of not considering state tax implications. You want to think about, right, the Internal Revenue Service and what the federal government might charge you, but some states are going to tax business sales differently. You might move to a new state long before you would actually ever sell. You might, just have a heads up of how your state that you're in might tax the sale based on maybe where you're located or even where your customers are. Great conversation to have with your tax pro. And then don't forget about basis adjustments. Missing those past improvements that could increase your basis, not tracking shareholder loan repayments, failing to document those capital contributions. Okay, that's things to think about to avoid taxes on the sale of a business. Now let's talk about estate planning and business succession. Maybe you aren't going to sell your business, you prefer to pass it down to the next generation. We've got some key tools for reducing estate taxes. One is a family limited partnership, FLP. These are a great way to start involving your adult children and gift them parts of the business each year rather than they get it all at once later. This can save on estate taxes, can also give them the skills they need to run the business, all those kind of things. But don't worry, you can still maintain control even while using the strategy. And you do that by setting up different levels of ownership so that you have the level that's the controlling part and you're gifting them the other level that they don't have any control, but they have ownership. Another option is a grantor retained annuity trust, a GRAT. This is a great option for rapidly growing businesses or businesses that have assets that are greatly appreciating, maybe like a real estate business, right? With this option, you're essentially, again, not giving tax advice here or legal advice, but essentially, simplifying it, you're gifting at today's values, and the growth of that value is not included in your estate later. Okay, so you can gift today's value, and then it could grow millions of dollars before you die, and all of that growth is not factored in. That's called a grantor retained annuity trust, a GRAT. And then finally, some buy-sell agreements are a great option for to fund and make sure there are clear transition plans for death or disability. These are especially important for multiple owner businesses where you're in the business with somebody outside your family or a non-close relative. They're also really great for if you have maybe multiple children and only one wants to be in the business, and you can think about what needs to happen with the others. There's some common pitfalls to avoid here with estate planning and business succession. One pitfall is not coordinating business and personal planning. You want to make sure, as we talk about a lot here, that what works for you personally works for the business, and what you decide to do with the business works for you personally, right? Business owner focused here. You want the business succession plan to align with your personal estate plan. You want to consider the impact on non-business heirs. We call this estate equalization. Again, if you have multiple children, only one's receiving the business. What are you going to do with the other ones to make sure that they get an equal share, which equal or fair is not always equal, but we like to call it estate equalization as a shorthand there. And also plan for estate tax liquidity that way. Another common pitfall to avoid is forgetting about state estate taxes. Just like when you sell a business, the state gets involved. Same with estate taxes. Certain states have lower exemptions than the federal exemption. And you might, even while you avoid federal estate taxes, you might end up having to pay, or your heirs might have to pay state estate taxes. And then also, too many people just assume estate tax laws aren't going to change. The current exemptions sunset in 2026, and there's going to be much lower exemptions unless Congress takes action. And of course, also the federal limits can change, and the state limits can change independently too. So you kind of want to check in and make adjustments as those things change in both levels. Okay, so that's about estate planning and equalization, kind of thinking long range that way. Now, what if in the meantime, before you sell or before you worry about business succession within your family, what about before then, if you want to do some retirement tax planning, right? You're going to retire from the business, but still own it. And here there are some special considerations. In the first episode this month, we talked about the different tax buckets for retirement savings, the taxed later bucket, the taxed now and not later bucket, and then the never taxed bucket. You could also think about capital gains tax rates versus income tax rates, all those fun things. You might have some traditional pre-tax accounts where you've gotten immediate tax deductions throughout the years and your taxes are due on withdrawals and you have to start required minimum distributions at 73. You might have Roth or Roth-like accounts where you didn't get a tax benefit later, but now you can use it tax-free and there's no required minimum distributions on those, things like Roth IRAs or Roth-like accounts like Bank on Yourself type whole life policies. And then you might still have some taxable investments where you pay taxes as you go. Maybe you also have some things that you pay taxes when you sell them, and because you held them for more than a year, then you get capital gains rates. You might have some that get a step up in basis at death and others that wouldn't. All of these kind of moving parts tax-wise is what you might already have. But there are some very specific retirement options for business owners that can help fill in these buckets in a way that works for you. So one of them is called a cash balance plan that you might use in your high income years. You know how like a IRA, you can only contribute $7,000 as of 2025 with maybe some catch-up room. 401k might be about $40,000 to $60,000. I forget what the exact limit is right now. Well, these cash balance plans you can contribute $200,000 or more annually. This really works well if you've got consistent profits. Just be aware, if you've got employees, you have to cover them. Another option, solo 401k, SEP IRA, you can use those, maybe Roth types. This might be better if you've got a spouse involved in your business. That kind of gives you that tax later bucket, kind of like the cash balance plan, but a little smaller contributions. But here's the thing. What this all boils down to is there are some unintended consequences of profitable business ownership after 65 years old. Things that people just don't think about. They get to 65 and they're like, oh, I did all of these things to lower my taxes up until now that I have to deal now with the consequences of those things. For instance, business income can impact how much of your Social Security gets taxed, right? And especially if you sell a business after 65, that's gonna have, for sure gonna put your Social Security taxable, if, unless you're selling it for very cheaply. It would impact your Medicare premiums, right? How much do you pay there? And the surcharges with that 2-year look back, all those kind of things that can add thousands to your healthcare costs. And then, so this is where you want to look for, you got those high years where maybe you've deferred some things. You might have some lower years where you can control your taxable income for the longer time. Maybe you do some Roth conversions during those lower years. Maybe you plan for some qualified charitable distributions from your pre-tax accounts that you're going to incorporate into your retirement planning. Maybe you strategically time when you're going to sell the business and when those payments come out, maybe before RMDs start, right? There's all kinds of fun things to play around with there. You just have to be thinking long range, not just about today. Okay. If all this sounds complicated and expensive, stay tuned after the break. We're going to keep breaking it down, helping you make some good decisions.
Ready to take the next step towards securing your financial future? Whether you're planning for retirement, saving for your dream home, or you just want to make your money work harder for you, the team at Wealth Wisdom Financial are ready to assist you. And now, it's easier than ever to see how we might give you a boost on your financial journey.
Schedule a 15-minute discovery call with one of us today.
And let's discuss your questions and your financial goals together.
Don't wait any longer. Your financial freedom awaits. Schedule your discovery call at www.wealthwisdomfp.com/call.
Complication and expense, right? This is where most people go like, holy cow, do I really need to worry about this now? Actually, yes. The earlier you start, the more options you have. Remember Sam, the one who sold his business for $2 million? If they had started planning just 5 years earlier, they could have structured the sale differently to save over $200,000 in taxes, used gifting strategies to move some of the business value to their kids tax-free, and built up Roth and Roth-like accounts to provide tax-free income, especially during those years where they're getting the income from the sale, right? Great ideas, love those. And of course, they factor in multiple things from each of the things we just talked about. One of the great things here is by being proactive, by starting earlier, you have more options. You can strategize, if we sell, here's what we do. If we give this to our kids, here's what we do. And if we just retire while still owning the business, here's what we do. And often there's things that work for all three circumstances that you can do no matter if you're just, I don't know what I'm going to do. What it comes down to is having an honest conversation with your money team about preparing early and often. That's when you can have the conversations and you can put into action what you talk about. And if you don't have time to do it, consider if you can delegate other things to create the time, right? Things that somebody else can do, at least 80% is what you can do. Delegate that so you've got the time to put into some of those higher level things that only you can do. And also think about how an ounce of time could save pounds of time later for you or for who has to pick up your mess. This is an area where an ounce of prevention can literally save pounds of cure later, right? Or a couple dollars spent on prevention can save you lots of dollars in taxes and fees and all kinds of attorney costs, all of that later. Okay. In conclusion, long-term planning isn't just about avoiding taxes. We talked a lot about taxes, but there's all kinds of other ways that you want to be strategic about when and how you pay your taxes, how you avoid other fees, attorneys, right, all those things. The best time to start is right now when you have the most options available. Too many business owner conversations with their tax pros are all about saving taxes this year or next year. Be sure you're scheduling time with them, talking about long-term tax planning, adjusting your plan regularly. And this is often where a certified financial planner, a CFP like me, comes in really handy and can have even better conversations, give you better tools and resources to go and bring to your tax professionals and all of that. Thinking through what are your goals, what's the likelihood of a sale versus retiring while you still own it, all the pros and cons and how it fits into the rest of your portfolio. That's what a CFP like me does and loves doing. So, are you ready to start your long-term tax planning? We've created a business owner's legacy planning guide that walks you through the key decisions that you need to make. You can get it for free in the Wealth Wisdom financial community, along with a checklist of questions to ask your tax and legal advisors. And we'll also include in there a link to schedule a call with me to have these kinds of conversations about legacy planning as a business owner so that you can have more custom tailored questions that you can bring to your tax and legal advisors as well, and make sure you get all your ducks in a row as quickly and efficiently as possible. Thanks for joining me. Hit that subscribe button. We've got some really cool things planned for the month of April. We got the taxes out of the way, hopefully, and now we're ready to move on to more fun things. In the meantime, I hope that you live long and profit. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, tax, or investment advice. On such matters, please consult a professional who knows your specific situation, and maybe share this episode with them so they can know what you've been listening to and what you are going to be wanting to talk about with them very soon. Take care.